Returns probably can't stay as high as they have
further
in the last
assets
few
bought
years.
at the right time.
Not only various stable
Right.
trusts, things that are control. The biggest challenge is to find the right people.
Fear is stalking the street, and the world of the debt markets and the implications of what's going on in the debt markets are becoming more and more evident to us every day. And for all of us who thought that when we came back from the summer things might start to get a little bit better, think again. Most of us who thought it might be getting a little bit better by now, think again. All of us who hear our banks tell us, well, we'll be back in business in January. Big question. So it's kind of curious when you're being asked to make this sort of presentation a few months ago and see a world change quite so dramatically since that time, that I feel so many of the slides you're going to see and I'll run through are basically totally redundant. That all those graphs you're about to see going like that just fell off a cliff.
It's very nice to be back in Brighton. It's not just nice, it's reassuring. There's lots of familiar faces, colleagues, friends, competitors from a long time ago. Why do I need reassurance? I need assurance, not reinsurance, because we live in an age of uncertainty, an age of huge volatility. Let me just illustrate this in a few ways. If you had been lucky enough or shrewd enough to buy one Landsec and one British Land share about 5 years ago, and then before going on your spring holiday you thought you better sell them to pay for your spring holiday, you would have made 3 times your money in 5 years. 3 times your money on a share that was asset-backed, income-backed, passive investment, no work. Extraordinary. Suppose, however, that you came to the party a bit late in the day and you actually only bought the 2 shares this spring. You wanted to join the party. This morning you panicked. You phone up your broker and say, get me out of this basket case investment. And your broker would tell you that you have lost 45% of your investment in 6 months on the same asset-backed, income-backed, passive investment. It's a very uncertain age.
Dr. Cullen, the focus of this year's conference is indirect investment vehicles, but really the talking point is the current financial and credit crisis, isn't it?
It certainly is. There has been an enormous interest in our numbers in the very recent past and where they're going in the very near future. Yeah.
Gerald Parks from Lehman Brothers began his presentation with the words, fear is stalking the streets. Indeed, you have organised extra sessions here to cope with concerns regarding the markets, the present state of the markets. What will be discussed in them?
We will simply be looking at the whole spread of results globally from our indices because that project is very close to our hearts and is the big picture against which the UK results must be read, but the main focus of this extra session will be on the latest UK monthly index results, the fact that that monthly index is turning down at a rate which we've never really seen before, and the concern about what that means in terms of medium-term UK market response to the financial circumstances at present.
Now the results you mentioned have just come out recently. The IPF also released results gauging sentiment, which seems to be at an all-time low. Everyone knew there was going to be a slowdown in 2007, but does it look like it's going to be worse than expected?
I think expectations are hugely varying at the present time, ergo the interest in any evidence that's available about precisely what's happening. The market has actually been gently bouncing downhill since its peak in December 2005, but the step that we hit in about April of this year, with a slight bounce back after that, has now been followed by this rapidly accelerating decline, and there's no sign of the next step, frankly.
Are we being unnecessarily negative about it? Property is still a very important asset class for investors, and I just want to know if there are any sort of patches of light amidst the gloom at the moment.
Yeah, that's why the uncertainty is so great, because there are many patches of light amongst the extremely dark patches of gloom. Rental growth continues solidly but modestly positively forward, so that growth rate has ticked over at about 1 to 2% month after month after month. So that is one level of defence. That's reflecting occupier demand, which is certainly not disappearing, which in turn reflects a host economy where GDP rates of growth are still solidly positive. It's all in investor sentiment that the concern is rooted. And investment sentiment is currently driving yields out at this enormously rapid pace, taking capital values down with it, irrespective of underlying rental value growth, underlying occupier demand.
All right, now the focus of the conference is in direct investment vehicles, and the rise of the alpha manager is the tagline I've seen associated with the conference. The industry itself has seen dramatic growth in the number and types of investment vehicles for investors to get into property. Are they going to disappear as quickly as they arrive, given the current state of the market?
No, I don't think they will disappear. The increasing exploitation of indirect vehicles, I think, is something which is a long-term structural trend rather than something driven by short-term cyclical factors. We don't know how short-term cycles are likely to be in any particular economic circumstances, but I do not see this as marking the death knell of indirect vehicles. They have become one of the major tools of choice, if you like, for end investors to achieve exposure to parts of the market that are best delivered through specialist management or large lot size possibilities offered by indirect routes. So I think they're still with us. What we will see, and this is something I will talk about in my paper, is pain associated with the level of debt which has been introduced into some of these indirect vehicles.
Now, there are lots of different types of vehicles, and many arriving on the scene in the past few years. And can you tell us, or can you quantify for us the sort of impact they've had on the underlying property market?
Difficult to speculate about cross impacts on the underlying property market. Clearly, the different levels of liquidity of different sorts of vehicles provide information streams which are assimilated in the process of delivering property returns off the whole marketplace. So as we see discounts to net asset value increasing in listed property company prices, that will no doubt be something that valuers take into consideration when they look at direct property. Equally, as we see derivatives prices falling, reflecting negative sentiment in that part of the market, so that will be factored into people's considerations of the direct market. And in a context where it is actually sentiment that is driving the short-term shape of performance, then clearly these other information streams coming off listed sector results or indirect market pricing are going to be significant.
Are we going to see more or less of these vehicles in the foreseeable future?
I think in the short term there will not be a raft of new inventions. I think that in these difficult market circumstances, derivatives will be exploited, probably to a greater extent rather than a lesser extent. I think in the long term, the trend is still in favour of the exploitation of indirect funds.